Bhatia on Twitter Spaces, YouTube, also on WOR, New York's big AM talk radio station, talking to Nick about Bitcoin, the U.S. dollar collapse, and more. For people who are not familiar with your work, Nick, describe what you do.
Sure. Thank you for having me so much. I appreciate it. My name is Nick Bhatia. I'm the founder of the Bitcoin Layer. We're a research provider analyzing Bitcoin through a global macro lens. My background is in U.S. Treasuries and the traditional investment management industry. I was involved in trading U.S. Treasuries as well as forming interest rate strategy in the asset management industry. And I wrote a book, published it in 2001 called Layered Money. And Layered Money is a book about the history of money and the future of Bitcoin and digital currency.
So you also did stuff with U.S. Treasuries. What did you do with that? You're trading swaps or what?
Yeah, so I worked at an asset manager. Our clients were large institutions, and so I acted as a fiduciary for those clients, and I was in charge of trading U.S. Treasury securities across the curve, as well as contributing to U.S. Interest rate strategy decisions.
And what brings you from doing Treasuries to getting into Bitcoin?
Yeah, so U.S. Treasuries, serve as the center of the U.S. dollar financial system. When U.S. dollar holders own dollars, what they own is a form of a dollar liability. And so who is the counterparty of those dollars? Oftentimes it's banks. And when participants in the dollar market need security, they need safety, they forego those dollar deposits and dollar liabilities of banks, and they buy U.S. Treasuries. So that's why U.S. Treasuries are called the risk-free asset within the dollar system. It's not that the Treasury Department has zero risk. It's that the Treasury Department is the lowest risk counterparty throughout the entire dollar system. So I was involved in the Treasury market for many years, and interest rates is really my core competency, and that's what I studied in school as well. And when I was on the desk and involved with the markets, I came across more and more literature about Bitcoin and its potential to disrupt the finance space. And I started reading about Bitcoin. And once I understood Bitcoin as a software protocol and as a true innovation in the history of computer science, and something that had the potential to really change the way we interact with money, it's something that I couldn't unsee. And from that point on, that was in about 2016, I started researching and writing about Bitcoin. That culminated with my book in 2021 called Layered Money.
We're with @TimeValueBTC on Twitter. Also, Bitcoin Layer founder Nick Bhatia. He's the founder of the Bitcoin Layer. So what prompted you to find the Bitcoin Layer?
So after I published Layered Money, I saw that there was a ton of energy around trying to understand the future of money with both Bitcoin and the dollar system at play. So the idea that Bitcoin is going to end all currencies is not something that I believe in any medium-term time horizon. And so what I wanted to do is explain and narrate the transition toward a Bitcoin-centric world as it happens. And I knew that that's a multi-year story and even a multi-decade story. And so my mission at the Bitcoin Layer is to cover and analyze how Bitcoin fits into the future of money. And that also heavily involves looking at the global macroeconomy, the US economy, and the interest rate and other risk markets, and analyzing all those components together as one research provider. So we have a newsletter, a free newsletter that goes out every week. People can find us at thebitcoinlayer.com. And we also have a YouTube channel and podcast as well.
So break down the future. How do you see that decade by decade approach?
Sure. So the idea of the collapse of the US dollar is something I think is quite overblown as we stand today. The dollar is so deeply entrenched in the financial system that any demise of the dollar over the next decade, let's say, is highly unlikely to me. Now, I take you back to 2010 when we're just coming off the great financial crisis, and China and Russia announced a bilateral pact to ditch the dollar and settle all cross border trade in local currency, so either Chinese yuan or Russian ruble. And that was in 2010. So, over a dozen years later, we still see the Chinese yuan at only 3% of global FX reserves. Now, while the dollar has declined from about 70 to about 60% of global FX reserves, this is actually because of the slow and steady rise of the euro as a regional settlement currency and not because of any long-term threat to the dollar from China. And so I believe that the US dollar is going to remain the dominant global currency, both on the settlement front, the FX reserve front, and not to mention the dollar is still 80% of the global oil trade settlement currency as well. So the long story short about the dollar isn't going anywhere. Bitcoin is one of the four currencies on the horizon to challenge the dollar in terms of international settlement. Those four being the euro, of course, the Chinese yuan, gold, and Bitcoin. And when it comes to Bitcoin, I believe that Bitcoin has the makings of a global settlement currency because of the path of adoption. And let me explain that. Right now, we have over 50 countries in which the Bitcoin adoption rate is over 10%. That's a staggering number. That means over a quarter of the world's countries have a significant portion of its people that own Bitcoin or are using Bitcoin in some capacity. And that number is above 20% in over a handful of countries. And it's actually over 18% in over 20 countries. So we see this slow and steady adoption of Bitcoin across the world as people recognize Bitcoin as a global neutral currency, just like gold is, and just as gold has been for thousands of years. Now, I don't believe that gold is in the future monetary system just because a physical commodity like gold compared to a digital internet-based commodity like Bitcoin, I just believe that in the digital future, Bitcoin is going to take away what gold has been for the world in terms of that neutral, apolitical currency. And Bitcoin is already larger in its size today, call it 600 billion, than all the foreign ownership of Chinese government bonds today, which is about 500 billion. So Bitcoin is already taking that role in terms of being an alternate reserve asset. And it's still early days, but in only 14 years, Bitcoin has already grown to the size that the rest of the world, to the degree that the rest of the world owns Chinese government bonds. So a quite staggering rise in Bitcoin in a very short time horizon. I want to remind the audience that Bitcoin and crypto are not the same thing. They're incredibly different constructs. We can get into that. But Bitcoin by itself, not crypto, but Bitcoin does raise or does bring about a potential future centric piece to the global financial system in the coming decades.
We're with Nick Bhatia of the Bitcoin Layer. And your latest book, what's your latest book?
So I wrote and published Layered Money in 2021, from gold and dollars to Bitcoin and central bank digital currencies. And I take readers through a history of money and really start the story in 13th century Renaissance Florence, identifying gold and the double entry accounting system as the basis for a construct called layered money or monetary hierarchy, in which we use balance sheets to issue money and transfer money around the world. And that's the system that we use today with treasuries, dollar deposits, central banks, and commercial banks. We know that commercial banks are in charge of issuing money to the public. Central banks are there to be a lender of last resort and have taken a much larger role in the issuance of money over the last decade and a half as we've seen financial crisis after financial crisis. So I recommend people go check out the book, Layered Money. It's also available as an audiobook and available in over a dozen languages as well around the world.
Folks, give me a follow on Twitter at Your Financial QB. Also, Nick Bhatia, we're on Twitter Spaces, YouTube. I'm coming over from Bitcoin Clubhouse because Clubhouse is dying. So giving Twitter Spaces a try. So, Nick, if you want to come back on Twitter Spaces, I don't see you anymore. Like your face.
The audio,
it kicked you off? Okay.
It's doubling.
It was bad. Okay. So give Nick a follow too. He's at Time Value BTC. So give us a history of money. I mean, I know it's in your book, and what I do during the day, I'm a fee-based fiduciary firm where we appreciate the value of Bitcoin as I like the distinction between Bitcoin and crypto. I really don't believe in any other crypto project. I haven't seen, any use for it. I get Bitcoin, love it. So break down for people, because we're on New York radio. We're all around the country with iHeart, Spotify, around the world. Somebody's new to Bitcoin, kind of break down the history of money, because we one time had Neil Ferguson on talking about his book. But I don't think people get it. I mean, maybe if you're really into money, you get it. Maybe if you kind of geek out on this subject. But for people who don't really know what you're talking about, let's start in Florence with the Medicis and all that stuff.
Sure, and I do recommend Neil Ferguson's book, The Ascent of Money. I used it as research in the writing of Layered Money, so I definitely recommend people check that out as a supplement to Layered Money. But let me start really quickly with Bitcoin versus crypto, and then I'll go back to Florence. The reason why Bitcoin and crypto are not the same thing is that Bitcoin does not have a central issuer. It doesn't have a foundation or a corporation or a person that is at the center of the issuance or the decision-making or the maintenance of the code or the maintenance of the network itself and the ledger itself. That is a highly decentralized process now that has built itself up over the last several years as more participants have come into the network. Ethereum and other cryptocurrencies have foundations or companies that can be subpoenaed that are at the center of those networks. And that's why Bitcoin stands alone as a commodity. And we see that with the Securities and Exchange Commission now coming down on crypto, on NFTs, on Bitcoin and crypto exchanges. They're coming down on companies and people that they can subpoena and bring to court and regulate. But regulating the use of Bitcoin and the network of Bitcoin would be like regulating the use of the internet itself. It would be unwise for the United States to ban or restrict internet usage, as it is a tool of speech that does have no particular central point of failure, right? The government can't just shut down one server and shut down the internet. It would have to shut down servers all over the world to accomplish that. So in a similar way, that's what the government or any government would have to do to stop Bitcoin. But to stop many of these other networks, they would merely have to subpoena or ban or restrict an entity. So that is, I think, an important distinction. Now, to go back to the history of money, human beings as a species recognized gold and silver as international money for thousands of years, right? We know stories about humans using beads or shells or feathers or animal bones, other sort of naturally occurring things on this planet as scarce money but converged around precious metals and had done so for thousands of years. But the invention of coins in about the 6th or 7th century BC gave way to the more centralized issuance of coins, the standardization of weights and measures, and that gave way to paper promises that promised to pay those standardized weights and measures of gold and silver. And so in that way, we developed a layered money system in which you have gold coins and pieces of paper that promise to pay those gold coins. And that system multiplies. It can turn into a fractionally reserved system. That's where banking leverage comes from. And in 1944 to 1971, we had this Bretton Woods system in which the dollar was linked to gold with an exact exchange rate, and all other currencies around the world were linked to the dollar and severed their link to gold. And over the course of 44 to 71, we basically had the exit of gold from the monetary system, and that formally ended in the early 70s. So since the 70s, we have been in a 50-year period of non-gold linked international monetary system in which treasuries sit at the top of the entire pyramid of dollars and really global money. And that period of 50 years has seen a tremendous explosion in the aggregate price level, but as well as it has seen tremendous global growth as well. So that system of the dollar, I believe, will carry on to the future, but it does bring risks, right? We've had several financial crises now since 2007, 2008. And we also have the rise of Bitcoin, another non-centrally issued currency, much like gold, that has really thousands of years of track record. And that's why I believe that Bitcoin does pose a potential really centric role in the international monetary system, because we've been looking for a currency that is apolitical to represent the internet age. And I think that's what we've found in Bitcoin.
We're with Nick Bhatia of the Bitcoin Layer, talking about the history of money a little bit. So U.S. Treasuries are hot right now. A lot of people want to buy them. What's your take? Is this a good time to buy treasuries? Is this a bad time? And obviously, we're not giving buy or sell recommendations over the airwaves, but I mean, lock your money up for a year, get 4% from the government, 4.5%. Pretty good deal right now. What do you think?
Yes. So, of course, we at the Bitcoin Layer also do not offer financial advice. We offer our research and investment opinion on markets. And what we're seeing right now is really, it is a tale of the yield curve. And so, by the yield curve, I mean, what are the yields across the spectrum of maturities in U.S. Treasury land? So right now, 3-month bills yield 5%. But 10-year notes yield only 3.5%. So there is a large, spread or curve, and an inverted curve right now across the U.S. Treasury yield curve. That is telling us that the policy rate at the Federal Reserve is much more restrictive than what the market believes long-term growth and inflation expectations are. And so that's why you have a 5% policy rate and a 5% 3-month bill yield, and you have 10-year Treasury notes yielding much lower than that at only 3.5%. And so, is it a good time to buy U.S. Treasuries? Well, when you consider bills, a 3-month bill at 5%, that is essentially a risk-free instrument that you'll be able to get an annualized yield of 5% over the next 3 months. Now, the reason why longer-term yields are much lower is because investors believe that yields are going to decline over the medium term, as we have reached the point where we are at the end of the economic cycle. The Fed has already tightened monetary policy by 475 basis points, soon to be potentially 5%. And the Federal Reserve will have to cut rates over the medium term, let's call it the next year to 2 years, as the U.S. faces economic contraction. So staying in the part of the yield curve that is in the shorter end is almost by history standards expected to uninvert, meaning that we will see the long-term yield rise relative to a short-term yield falling. And so people that are investing in bills will be able to capture this high policy rate, but it is expected to fall over the medium term. So if you buy, let's say, a 3-month bill today at 5%, it might be only 4.75% in 3 months. It might be only 4.5% in 6 months. So each time you go back to the market to buy that bill, it will probably be lower in yield. And so investors have to realize that too, that yes, the yield on bills right now is quite attractive and it is risk-free. But when that bill matures, what is going to be available in the market? It certainly won't be 5% again, I think, in the next year.
So you may want to lock them up for longer,
And that's what brings in what we call duration or interest rate risk. That's the sensitivity to interest rates rising and your price sensitivity to interest rates rising. So as we saw in 2022, when yields rise as dramatically as they did, it brings about a ton of price risk to long-term bondholders, and they suffer as rates rise. So, recommending that investors get involved in the longer end of the curve right now, it's dangerous in that any rise in yield or resumption in growth expectations or inflation expectations will bring material price risk to investors. So they need to understand that and pick the point on the curve where they are most comfortable balancing the risk of interest rate sensitivity with the yield that they're getting.
Yeah, but I always look at, I help a lot of people, they're retired, nearing retirement, boomers. If you have $2 million and you could tie up, your money for 10 years and get 4%, 80 grand a year plus Social Security. I mean, maybe you're not that blessed, but some of these people, you got to focus on your overall financial planning goals, needs, objectives. We're not giving financial planning advice, but I think in a lot of ways, I help listeners for years, and they said, Josh, if I only got 4% on my money, I'd be happy forever. And now they have this opportunity, and some are pulling the trigger, some aren't. Obviously, the risk is, hey, we go up to 6%. Nobody wants your bonds. But, I think it's a good opportunity for many people. I do think in the Bitcoin communities, there's been two theories and financial planning community. One would be represented kind of by Lacey Hunt, Jeff Snyder. Okay, doom is coming, recession is coming. Even though people say, oh, Jeff Snyder's not really predicting things. But if you listen to him for like 2 years, it's all negative. Dour, euro dollars are going to have problems. Rates are going to go down. And they've been wrong. I mean, I've had them on the show for years, the last 2-3 years. I love them. They're great guests. They're exciting. But for the last 3 years, those guys have basically been wrong. And then a narrow kind of contingent, you might say, not really Bitcoiners, but Larry Summers, David Ranson, if you're familiar with him. A couple people here and there have said, hey, rates are going to remain persistently longer and higher because we're just, we're going to be at, maybe we're not going to have 9% inflation, but we're going to have 5%. It's going to be sticky, take a few years to get out of this. Which camp on that would you be?
My general bias right now is to lower yields over the medium term as we head into recession and the Fed is forced to cut rates at some point over this next 12-month period. Now, into 2022, it was so obvious that the Fed had to fight for its reputation and hike rates that bond prices were going to come under fire. But at a certain point last year, it's when actually yields hit about 3.5% on the 10-year note. And they did have another leg higher in yield after that point. But when they hit at about 3.5%, I started to believe that treasuries were again attractive. As I do, my bias is toward more disinflationary forces on the economy here in the next few years, right? The inflationary wave that we had came from three places. And anybody that says they are able to identify that it was only one of these three places, they're wrong, right? The three places are supply chain disruptions due to the pandemic, fiscal stimulus due to the government rescues around the world, and monetary stimulus to respond to liquidity conditions and fiscal stimulus itself to finance that fiscal stimulus. And the inflation that we saw in 2021, 2022 came from these three sources. Now, we don't have supply chain disruptions nearly to the extent that we did during the pandemic. We have no more fiscal stimulus that is active. I understand there's some fiscal stimulus that has not yet been deployed, but we also have monetary tightening instead of monetary stimulus. So you have higher interest rates and you have balance sheet unwind, which is quantitative tightening instead of quantitative easing. So all three of the inflationary forces are gone and have been gone for several months, and that will bring about a reversion to the mean. And it should support the prices of US Treasuries, meaning that US Treasury yields shouldn't be rising materially in this environment as we head into a slower economy. And we can get more into the economy, but I mean, we are really showing so many signs of late cycle activity as business confidence contracts. We see credit contracting post March mini banking crisis that we had. We see housing prices now heading for annualized declines. We have seen month over month declines in housing prices for several months now. And we see building permits falling. You know, the trend is falling for several months. And we are starting to see unemployment claims rise off of the lows. And those are always early signs that we are at the end of the economic cycle. So I am expecting a tough year for the US economy. I don't think the Fed is going to rush to cut rates unless we have some sort of risk off event in markets. The Fed is highly sensitive to risk markets, and they're not as sensitive to the economic data. So they see slow economic data. They've even admitted we are heading into a recession later this year. We found that out in the minutes that were just released from the March meeting. The Fed does believe we are heading into recession, but they are still saying that they're going to keep hiking rates at least by another 25 basis points as they continue to fight inflation. And why are they doing all this? Because stocks aren't dumping. So there's no consequence for the Fed to keep hiking rates. And so only until you see the stock market challenge the Fed will you see the Fed start to reverse course. And so I agree with the people that think they can keep rates higher for longer as long as risk markets don't dump on that sort of thing. And right now, the S&P is well off of its lows from last year, and it's not, really back challenging its all-time high yet, but it's hanging in there. And as long as the S&P 500 hangs in there, the Fed isn't going to cut rates. And that's kind of how I see the next several months playing out.
Do you think we retest the October lows of last year on the S&P?
That's the big question. And that's what I'm looking for here is that the Fed won't stop quantitative tightening and it won't really get into rate cuts unless it sees the S&P 500 challenge those lows. And so I do think that the rest of the year has a lot of pressure on risk markets due to the declining liquidity in the system, credit contraction, and quantitative tightening. And so basically, the answer to your question is yes, I am expecting some sort of challenge as we get more and more information that tells us that corporate profits are declining and the economy is in contraction. So but we know how sensitive the Fed is to risk markets. So any jawboning from the Fed that they're, thinking of pausing or cutting rates could support and should support risk markets, but that will battle with the recessionary forces on corporate earnings.
What if this is just a mild recession? Market corrected 20% last year, and we kind of go through this. I don't know. I mean, when you're predicting, it's futile to some degree, but I could see us kind of have some other event like the banking crisis. Maybe we retest the lows of last October. But it seems like, hey, if Charles Schwab stock goes down, and we're not recommending you buy or sell it, what was it down? 40%? If it goes down 40% in March, and then we survive that type of event, now, I'm not Silicon Valley Bank. I mean, that makes sense to me. But what didn't make sense is how this kind of contagion from Silicon Valley and First Republic, those banks made sense to me. Charles Schwab didn't, still doesn't. But sort of when you have other innocent bystanders, if you will, being taken out or depressed, do you see anything else like that on the horizon?
I actually think that as a research analyst myself, my base case scenario needs to be a mild recession, because predicting a great recession would be very far from the mean expectation in late economic cycle, which is where we are. So, forecasting or predicting a mild recession actually should be the bias here. And that is because of the resilience of the U.S. economy and, the relative advantage of the U.S. economy versus the rest of the world. And so I do believe that in that resilience, the U.S. will be able to come out of contraction and find itself back in growth in short order. But we'll have to watch the data unfold just to see how deep the contraction could get, right? If we see unemployment spike, if we see unemployment claims really start to rise, we see corporate profits decline materially, then we can adjust. But right now, with month over month housing prices declining for over half a year now, it's fair to expect that we're going into a recession. We should expect it to be mild, as the average recession is mild, and we'll adjust our framework as we go.
What are your thoughts on the recent bank collapses? Is there more to come?
Well, we right now, listen, in my book Layered Money, I call the Fed the lender of only resort, right? It's not just the lender of last resort, which is an institution in central banking that has been in existence really since the 19th century, and the Bank of England. The lender of only resort, Federal Reserve, came in March with a new facility, right? The BTFP. They came in with increased liquidity offerings to foreign central banks that need swap lines. And they also made available their discount window, as it always has been. But the utilization of that discount window is now a non-zero, where it typically is when we're not in financial crisis. So the Fed coming in, doing their job, lender of last resort, has prevented further bank failures, right? We're in late April now, and we haven't had a bank failure in April. So the Fed's emergency facilities have accomplished their mission in the short term, but the utilization of the discount window and the BTFP is still non-zero. And while it's declining a little bit week over week, the fact that banks are still using these facilities means there is still some dollar shortfall, right? That is the Jeff Snyder thesis. He's always talking about dollar shortages. A dollar shortage means the bank can't find the next loan of dollars to itself. The depositors are leaving. The capital markets are less available to them as rates are much higher. So they can't borrow from the markets in the same way. So who do they have to borrow from? The Fed, either by posting their treasuries as collateral at a discount or without a discount and posting them as collateral. So there is a dollar shortage right now, and that should send banks under, if not for the lender of last resort, which is the Fed. And so right now the Fed is accomplishing their mission, preventing bank failures. And for me to think that predict even that another bank failure could be around the corner when the Fed has all these bullets, I think that would be, a little presumptuous. So it's very difficult to just outright predict more bank failures when the Fed has so many tools. But again, the economy broadly is under pressure. The Fed cannot just print economic activity. It can print dollar liquidity, but it can't create economic activity by itself. And so the broader economy will affect banks, and that will affect markets as well. It'll affect the stock market and will affect the Fed's liquidity measures. So we just, even though there's a risk, there's always this Fed savior, right? That's the Fed put. And the Fed is trying to challenge that right now. We'll see how long they're able to keep rates higher for longer. That's the big story of this year.
We're with Nick Bhatia of the book Layered Money: From Gold and Dollars to Bitcoin and Central Bank Digital Currencies. And Nick, you say it rarely occurs, but the international monetary system is on the edge of an overhaul. Can you elaborate on that?
Yes. And the international monetary system, which consists of countries and companies, have for the last 15 years, since we have been in financial crisis, calling for alternatives to the dollar. The central bankers of the world, politicians of the world, citizens of United States and other countries, they're all calling to an alternative to a system in which the Federal Reserve can just print infinite amounts of liquidity and save everything in its sight. Now, the deep entrenchment of the dollar system, I don't believe, is in immediate demise, but long-term alternatives to the dollar, such as Bitcoin, are being explored. That's why China and other countries that trade with China are trying to use Chinese yuan in international settlement, because they're searching for an alternative. Now, the actual adoption rate of Chinese currency in terms of Forex reserves, we discussed, it's only 3%. Now, it's not zero, but it's definitely nothing to even challenge the Japanese yen and the British pound, which was the world reserve currency over 100 years ago. And so that's how far away we are from other countries or the EU challenging the dollar. But we still can see adoption of Bitcoin, Chinese currency, other bilateral currency swaps, countries coming together and forming agreements that they want to search for ways around the dollar system. We're seeing all these things happen. And so over the coming decades, that is the story. That's what we're covering at the Bitcoin layer. We want to be here to explain and demonstrate that Bitcoin as a neutral currency has the ability to replace some or most of the financial system, but it will take a lot of time. And here are the steps along the way. And by the way, the international relationship between China and the United States, which these two countries have been in a technology Cold War since 2018, when US companies were restricted from selling hardware and software to Chinese telecommunication service providers. This technology Cold War is a big deal and does affect the dollar strength. It does affect the Chinese currency's ability to internationalize, and it does pave the way for Bitcoin to become a more important challenger relative to the Chinese yuan over the coming decades. So that's another thing that I think it's important to watch, and something that we analyze as well at the Bitcoin layer.
It was interesting. I had Lacey Hunt on one time, and he said the only thing that's going to stop this kind of wet blanket disinflationary environment, he was kind of likening the period we are in right now to like the 1840s or something. He said the only thing that really fueled U.S. economic activity was the the gold rush in 1849. And kind of that innovation sort of propelled the U.S. forward for the next 150 years. And he's not really a Bitcoiner. He doesn't really comment on that. But I was thinking, Bitcoin, if the U.S. kind of embraces Bitcoin as some type of tether to normalcy, that if, people want balanced budgets and We don't print money to ad infinitum, although we did it again with this bank facility. So I want to get your take on that. But, I thought Bitcoin might be that layer of ingenuity and the U.S. embrace of it and not kind of constricting it that would propel American ingenuity forward for another 100 years. What do you think about that?
I love that concept. I am a proponent of that idea. And it is part of my mission to explain to Americans, whether it's citizens or policymakers or institutions, that embracing Bitcoin as just another innovative technology, just as the microprocessor, semiconductors, the internet, smartphones, app stores, Bitcoin is just another one of these incredibly powerful technology innovations that is purely American in nature, right? We embrace innovation in the United States. We embrace technology. We use technology, and we are the first to build upon these new technologies. How many of these social media conglomerates come out of Europe, Asia, South America, or Africa? The number is zero, right? And that is because the entrepreneurship, innovation, spirit, and culture in America is just that much stronger, or just strong in general relative to the rest of the world. And so Bitcoin should be another form of technology that is embraced by the United States to continue its relative technological advantage. And I already see that. We see first of all, we see Coinbase and several other Bitcoin miners publicly traded now. So the idea that the US is going to ban Bitcoin, I mean, it's a ridiculous concept, because since 2014, the IRS has recognized Bitcoin as property. This Commodities Future Trading Commission recognizes Bitcoin as a virtual commodity. The New York Stock Exchange and the NASDAQ have publicly traded Bitcoin companies, and the Chicago Mercantile Exchange has cleared Bitcoin and Ethereum futures, and has for several years, half a decade now. And so Bitcoin is being embraced in the United States. Bitcoin startups are coming up in the United States. They're not fleeing the US for other jurisdictions that are more Bitcoin friendly. They're here. And yes, there are Bitcoin startups around the world, but there are the most Bitcoin startups here in the United States. The Lightning Network and the build out of the Lightning Network, which is a Bitcoin second layer solution, a scaling solution for Bitcoin to make it make transactions, millions of transactions per second possible, microtransactions that doesn't have to be bogged down with Bitcoin's, slower settlement process. The Lightning Network innovation, again, is coming from companies that are in the United States, mostly. I'm not dismissing innovation across the world, but Bitcoin is American, and it is on that path to being a very American centric sort of innovation, just like the internet is today. The internet is used in every country around the world, essentially every country, but where are the major companies based, and where do they come from? United States. So Bitcoin is an opportunity. Politicians, policymakers on both sides of the aisle have to recognize this. Bitcoin cannot become a partisan issue. It's not. The internet isn't partisan, guys, and neither is Bitcoin. It's just technology, it's numbers, it's speech, it's cryptography, it's encryption. These are basic computer science components. There's nothing political about Bitcoin here.
Now, another line from your book that hit home, and the book is called Layered Money: From Gold and Dollars to Bitcoin and Central Bank Digital Currencies. For those of you just joining us, we're with the BitcoinLayer.com's founder, Nick Bhatia. You talk about how governments are unable to resist the temptation to create free money for themselves. That's how Rome fell. Looks like how the U.S. empire is falling. Other than pockets of, thinkers like, conservative people, Bitcoiners, libertarian types, it seems like we're kind of losing the war in the U.S. on kind of balanced budgets, sound money, principles of fiscal restraint. I mean, think about this. March, we had a crash, banking, collapse. Okay, government, save us. Government came to the rescue. I mean, eventually it's just going to blow the whole thing up because people are not going to talk about inflation. If they're just creating money out of thin air to help these banks, where's that money going? Could that be the inflation that remains persistent? Is that where we are right now with insurmountable spending and debt mounting in the U.S.? I mean, is there a point of no return? I'm hopeful. I think we can change things through education. Maybe I'm an optimist, but
I'm an optimist too. And so here's what I'll say. US debt to GDP was 100% a decade ago, and it's 120% today. And that's not a good trend. With that being said, it was 135% at the beginning of the pandemic and has actually fallen by 15%. So can the US actually have a falling debt to GDP? Yes, we can actually see that for the last couple years. It has fallen and continues to fall. But can it fall further to the point where the US fiscal position is much more sound? That is a challenge. I'm optimistic and I hope, but the trend is for continual deficits year after year. And so it's not a great recipe. We see the proportion of interest payments due on the debt rising in terms of relation to tax receipts. So how much money is the US bringing in tax and how much of that money is going just to interest payments on the debt? That number is rising. But right now, I do have that optimism that if we can find some fiscal responsibility and keep the debt to GDP ratio below its worst levels from the pandemic, and interest rates can fall back down and give the US a little bit more breathing room, that we are not headed for any sort of sovereign debt bubble or hyperinflationary collapse. These terms, the bursting of the treasury bubble or government bond bubble, with regard to the treasury market, it's not something that I really embrace. As we talked about, I do feel that rates are marginally heading lower over a medium term as growth and inflation expectations fall. So it is avoidable, right? The blow up of the US fiscal position. And it is possible to have more restrained fiscal habits. And so, but that's up to Washington. And thank God I am not a participant, but in the political scheme.
So thank you so much, Nick Bhatia, adjunct professor at the USC Marshall School of Business, founder of the Bitcoin Layer, and author of the book Layered Money from Gold and Dollars to Bitcoin and Central Bank Digital Currencies. You can buy his book wherever books are sold. Go to thebitcoinlayer.com or call us at 888-988-JOSH. And if you request a 45-minute wealth strategy session to fight taxes and risk in your portfolio, I'll throw in that book to you at no charge if you schedule and keep your no obligation review at 888-988-JOSH. I want to thank you for joining us, Nick. Thank you for those of you on YouTube, Spotify, Twitter. Give me a follow, hit the subscribe button, and thanks so much for joining us, Nick.
Josh, thank you so much for having me. I had a great time.
Bye now. Hope to have you on again in the future. I got to run.
Thanks, Josh. Yeah, take care. Appreciate it.
Take care. Thanks. Bye.